Warren Buffett and Jamie Dimon are making moves. And when the biggest players in finance act, we need to pay attention. Buffett is sitting on a record cash pile, warning that valuations aren't good for investing. Meanwhile, Jamie Dimon just sold $233 million worth of his JP Morgan stock on February 20th. But they aren't the only ones signaling caution. Even Walmart's latest report suggests the consumer is weakening. And now, government layoffs are set to explode. Trump's proposed Department of Government Efficiency could lead to mass firings of federal employees. But that's just the start. With 2 contract workers per every government employee, a ripple effect could take out millions of jobs in industries like defense, IT, and consulting. So what does all this mean for us? What steps should we be taking to protect our money, reduce risk, and prepare for what's coming? Let's break it all down. Let's look at the Buffett and Dimon warning signs. Buffett is hoarding cash, and I don't mean a little cash, record cash. Berkshire Hathaway has over $160 billion in cash, meaning he sees few good investments. In fact, he's not even buying his own stock. Dimon is selling JP Morgan stock. The CEO of the largest U.S. bank is cashing out while markets are still high. If the banking industry were strong, why would he be selling? When 2 of the smartest money managers in the world are playing defense, we should take that seriously. Recent actions by prominent financial leaders Warren Buffett and Jamie Dimon suggest a cautious outlook on the current market environment. Warren Buffett's cash reserves as of the fourth quarter of 2024 have reached an unprecedented $334.2 billion. This significant accumulation indicates Buffett's conservative investment stand, as he perceives limited attractive opportunities in the current market. In his annual letter to shareholders, Buffett emphasized the company's commitment to deploying a substantial majority of shareholders' funds into equities, primarily American, but only when favorable opportunities arise. Jamie Dimon's stock sale. On February 20th, 2025, Jamie Dimon, CEO of JP Morgan Chase, sold approximately 361 shares of the company's stock, totaling around $233.77 million. This transaction, executed near the stock's all-time high, has raised questions about the banking sector's future prospects, especially considering that Dimon had previously sold $182 million worth of shares in 2024. Key takeaway: the defensive maneuvers by both Buffett and Dimon through substantial cash holdings and significant stock sales serve as prudent signals for investors to exercise caution in the current market landscape. The economy is flashing red. The VIX, or the volatility index, a spike in market volatility, is usually a warning sign of instability ahead. The uncertainty index. Businesses are holding off on investments, signaling concern. Economists like Torsten Slok predicting a slowdown and potential recession. Walmart's earnings report. Consumers are trading down to cheaper products, meaning households are feeling the pressure. The key takeaway here is the data is backing up what Buffett and Dimon's actions are telling us. We need to be cautious. Stay informed on topics that help you live healthier and wealthier, and to receive actionable steps to improve your financial and health independence. Consider subscribing to our newsletter. By staying connected, you'll receive regular insights and updates tailored to support your journey toward financial resilience and well-being. The Trump administration's proposal for the Department of Government Efficiency could eliminate thousands of government jobs, but the real impact? Contractors. There are 2 contractors for every federal employee, meaning up to 1 million jobs could be in jeopardy. Sectors that are at risk: defense, cybersecurity, consulting, IT services, and logistics. What happens when government spending slows? Contracts dry up, companies cut costs, and private sector job losses follow. If your job or business depends on government contracts, it's time to prepare for a slowdown. The current economic landscape is marked by several converging factors that could signal potential challenges ahead. Inflationary pressures. As of January 2025, the U.S. Consumer Price Index increased to 3% year over year, up from 2.9% in December of 2024. This upward trend suggests that inflationary pressures are intensifying, potentially eroding consumer purchasing power and increasing costs for businesses. On February 1st, 2025, President Trump announced additional tariffs, 25% on imports from Canada and Mexico and 10% on imports from China. These measures aim to address trade deficits, but may lead to higher imports import costs, contributing to further inflation and potential supply chain disruption. This surge, coupled with proposed budget cuts in areas like energy, education, and agriculture, could lead to economic contraction in affected sectors. The combination of rising inflation, increased tariffs, and significant shifts in federal spending introduces uncertainty into the market. Investors may react to these factors, leading to increased volatility and potential declines in stock valuations. Sectors reliant on government contracts, such as defense and IT services, may face job cuts due to proposed budget reductions. Additionally, industries affected by tariffs might reduce their workforces to offset increased costs. Given these developments, individuals and businesses should assess their financial positions, considering diversifying income streams and preparing for potential economic fluctuations. Staying informed and proactive can help mitigate the impact of these evolving economic conditions. The current economic landscape presents several converging factors that may signal potential challenges ahead. The national debt and GDP ratio. Debt to GDP ratio exceeds 120% as of September 2024. The U.S. national debt reached a record $35.4 trillion, surpassing 120% of the gross domestic product. Historically, such elevated debt levels have raised concerns about a nation's fiscal responsibility and economic stability. To address the substantial national debt, the government may resort to inflationary deleveraging. This approach involves increasing the money supply, leading to higher inflation, which effectively reduces the real value of debt over time. While this strategy can alleviate debt burdens to the federal government, it also erodes the purchasing power of money disproportionately, affecting savers or the everyday American and those with fixed incomes. Inflation's role in wealth disparity. As the value of tangible assets like real estate and commodities often rise with inflation. Conversely, individuals without such assets experience a decline in purchasing power, exacerbating wealth inequality. Studies have shown that unexpected inflation erodes nominal assets and debts, redistributing wealth from savers to debtors. Given these developments, it's crucial for individuals and businesses to assess their financial position. Consider diversifying income streams and prepare for potential economic fluctuations. Staying informed and proactive can help mitigate the impact of these evolving economic conditions. Actionable steps to protect yourself. Identify third-party risk in your financial relationships. Where's your money tied up? If your bank, employer, or investments fail, how does that impact you? Are you dependent on one source of income that could be at risk? Review your brokerage accounts, banks, and financial counterparts, and what happens if they collapse. Number 2, look at cash and cash equivalents and layer your risk. Diversify your holdings across different sized banks, small, regional, and large institutions. Use T-bills, short-term treasuries, and money market funds to spread risk. Consider precious metals as a hedge against inflation and instability. Be mindful of FDIC insurance limits. Don't keep too much in a single bank. Number 3, reduce or eliminate debt and prepare for simpler living. If the economy tightens, being debt-free gives you more flexibility. Pay down high-interest debt first. If needed, adjust your lifestyle. Cut unnecessary expenses and prepare to live on less. In light of the current economic landscape, it's prudent to consider strategies that position you to benefit from potential asset sales across various forms of ownership. Here are actionable steps to consider. Position yourself to benefit from asset sales. Monitor market trends. Stay informed about sectors experiencing downturns, as these may present opportunities to acquire undervalued assets. Engage in strategic purchasing. When asset prices decline, consider purchasing high-quality assets at discounted rates. Positioning yourself for potential appreciation when markets stabilize. Diversify asset types. Explore opportunities across various asset classes, including real estate, stocks, bonds, commodities, to spread risk and increase potential returns. By implementing these strategies, you can enhance your financial resilience and position yourself to capitalize on opportunities arising from economic fluctuations. Now's the time to be proactive. Buffett and Dimon aren't taking risks, and neither should we. Protect your money, reduce your debt, and be ready for what's coming. What do you think about these warning signs? Are you making any changes to your investments or finances? Drop a comment below. And if you found this video helpful, hit that like button and subscribe for more insights on navigating today's financial landscape. See you on the next one.